Boom. It's all yours.
Great. What is this? Tuesday, September 12th, 2023. Thanks everyone for joining in. We are, so Lawrence and I are kind of tag team here working on the DMV REI Real Estate Investment Exchange group here in our area. We have a little representation, BJ, from the folks out in Western Maryland. We're going to get more of those folks involved too. So as you know, for those folks been here before, we try to do this on a regular basis. We try to do it at least once a month, maybe even twice a month. Always on a Tuesday night, always at 7 o'clock. We're going to advertise, as you all know. I'm going to tell you guys what to do in the chat and name, email address. I'll tell you that in a second. But we are having our own list to get the information out about future sessions. We also advertise in the private Gator Method Facebook group that Pace Community has, and also Lawrence on his side does it on the Sub 2 community too. So we want to spread it out to everyone. And really all this we're doing is once, every one of these sessions, we bring up one topic and stay on for about an hour, hour and a half, and just have the presenter, something like Mr. Terrell Hawkins here, come on, talk for half hour, 45 minutes, whatever amount of time it is about the topic. And then there's an open Q&A. And again, this is just a dialogue, conversation. We want everyone to walk away with at least one or two, at most 3 nuggets, right? So a lot of things to talk about. If you walk away with just 1 or 2 things that sticks in your head that you want to take action on, that's great. Mission accomplished. So what we'll do and go out the whole thing. So we guys can do 2 things for us. Number 1, go into the participant list in the Zoom and then change your name or change that title and rename it. You put your name, put your avatar. You know what avatar is? That's kind of like your persona in this community. Are you a connector? Are you an investor? Are you sub 2? Are you wholesaler? Whatever that is, right? You guys put that in there. You can also, again, depending on how much space you have in the title, put in a phone number or email address, or even better yet, in the chat, put in your name, avatar, email, phone number, whatever it is that you want. We'll collect all this information. We'll send it back out, have it all shared. But again, the idea is to foster community, foster togetherness, foster kind of everyone helping each other out and learning from each other. We're all here to make everybody successful. We're all here to help each other out. So, but I think that's enough of my spiel. Lawrence, I'll turn it over to you, and I'll be monitoring the chat and kind of helping moderate for Terrell. So don't worry about that. But again, fire away. We are ready to go.
All right, everybody. And Lawrence McKay, like Jose Leary, my co-host said, this is the DMV REI Exchange. This is where the go-givers come to receive, point blank, period, right? I don't want anybody in here who's just looking to kind of take. Like, if you don't come with a heart to receive, like, you're in the wrong place. If you don't come with a heart to give before you receive, you're in the wrong place. So I'll tell you that much. I know from the faces that I see and the names that I do recognize, I think we have the right group here. And with that being said, our speaker tonight, Mr. Terrell Hawkins, to me, he's been the ultimate go-giver. Not sure if any of you are really familiar with Terrell, but I remember Terrell, joining Sub 2, or, back in my earlier days when I joined Sub 2 back in 2020. And he was really one of the first people in Sub 2 that I spoke with, but he came with so much value, and he was always giving and always putting me on to things and always teaching me. Like, it was just really, really hard for me not to like this guy, right? Because every time I saw him, he had something to give, and I just felt like I couldn't ever give back enough. And just kind of staying with him, getting a chance to really understand who he is and understand that the mind that this guy has. Like, I couldn't believe the things that he would come up with and things he would create, right? And to watch him grow to the point to where he is now, I'm still amazed. Like, this brother amazes me every time I see him. So it's only right that once we have developed this platform, that we give him a chance to actually kind of display some of this information and share some of this information back with us, because I know where he really comes from. And when I first heard him start talking about infinite banking, I'm scratching my head like, hey, what kind of genie in a bottle trick is this? Like, like, I just didn't really understand what it was, but he actually took the time to break it down and really, really make it make sense for me. And for me, there was no other platform that he should be on to speak about this. And Terrell, I don't want to steal too much of your thunder, but I'm always going to give you your flowers because you're worth it. You've earned it. And I'm just going to open the floor to you, brother, Mr. Terrell Hawkins, aka Genius Extraordinaire. Floor is yours,
Terrell,
brother.
he didn't set you up at all. So you
No,
know
no, no.
the expectations
No, no.
so
So
don't mess up.
don't worry about that. Thanks, Lawrence and Jose, for giving me the platform. I really appreciate that. So I have a quick question for everyone here. How many of you do fix and flips or have done one in the past? I can't see how many. So Lawrence, I see Lawrence. So not too many. Okay. All right. So I'll go through a couple case studies, live examples and walkthroughs called illustrations. So basically, I'm going to be showing you the numbers. I spoke a couple weekends ago at Lawrence and Christina Aguilera's event talking about infinite banking, but it's going to be the same presentation, just slightly different. I'm going to do a live breakdown this time instead of just showing a couple pictures. So we'll jump into the slides. Lawrence did a great job, already introduced me. Again, appreciate that. But I'm just going to be breaking down how to use infinite banking to invest in the real estate. I'm an infinite banking specialist. Technically, I'm a life insurance agent. I mean, you have to be a life insurance agent to set people up with infinite banking. But I call myself an infinite banking specialist because realistically I am. So let me go forward. Cool. So my name is Terrell Hawkins. I am a graduate of Penn State University. I have a mechanical engineering degree. You see that right in the back next to the regret poster. CEO of White Iron Investments as well. I've been doing real estate investing for the last 3 years, wholesaling real estate primarily. Made over $300,000 in profit doing that. Mostly solo. I haven't had a team more than 5 people. And then I'm a licensed financial professional and life insurance agent. I'm mainly focused working with real estate people, real estate clientele, because that's what I've been in. So I know it. I know it. I know the problems that people have. I know the issues that people have. So I'm focusing on building solutions for a lot of people. And real estate is just the people that I can help the most right now, that I can help anyone. So let's jump into it. What is infinite banking at its core? It's a financial strategy that allows you to leverage permanent life insurance to become your own bank. Now, you're going to take advantage of the cash value in this policy, whatever policy we get set up, instead of you taking your money out of a bank account. Instead of you depleting your savings, you can utilize your cash value in your life insurance policy and duplicate your money. I'll go into that in a little bit. The rich and the wealthy have been using this for decades. Ray Kroc has used this for McDonald's. He used whole life in particular, since whole life was the main thing when he was alive. Used that in particular to fund the salaries of his key employees when he didn't have that much income coming in from McDonald's. J.C. Penney used life insurance, infinite banking to create his empire. Walt Disney used infinite banking for Disney. So it's a lot of people that used it, and it's also a key strategy used by the Rockefeller family for wealth duplication and asset protection, because those are the two things that this is beneficial for. That guy on the right, that old fella, that is John D. Rockefeller. A lot of people know him as the richest man in history. That's up for debate, but the truth of the matter is he has made a lot of people recognize what wealth really is. And his family controls a lot now because of them being able to duplicate their wealth and protect it from anything. Now, I'm gonna get into some of the basics. There's 3 ways money grows. It's fixed, variable, and index. Those are only 3 ways money grows, no matter how much or how little you have. We have the fixed accounts. Fixed accounts is your most used accounts. So you have the traditional bank accounts, your money market accounts, high yield accounts, even whole life policies are in this because they're fixed. So people typically like them because they're safe. I like mine because it's safe, but I don't like it because there's no growth or there's little growth in the account. The average savings account has less than 1% growth annually. Compare that to what the interest rate is right now and what inflation is. You're losing your value of your money every single year, just keeping it there. So you're working with a big con, but also a big positive that your money's safe. Now, variable. Variable is your less used accounts, your stock market, cryptocurrencies, Forex, 401ks, TSPs. typical retirement plans are variable accounts as well as real estate. Real estate can go up and down with the equity. We like this because your money grows. You can make a whole bunch of money real quick, as I'm sure some of you have seen with the AMC stock journey, as well as Bitcoin, all this. Those are variable accounts. It's a huge boom, but I'm sure you've heard of a lot of people losing money. And that's what we don't like, the potential loss. You could lose all or a portion of your money. The truth of the matter is this drop right here is a lot of people in 2020. Everyone I know that that has had a 401k in 2020 lost a third of their portfolio. I didn't even have a 401k and I lost a third of my portfolio just investing in some stocks because the market dropped that much. If you do not have principal protection, then it's going to take you way longer to get back to where you were. Then we have index. Indexed accounts are your least used accounts. This is your fixed index annuities, adding insurance to your retirement plans, adding insurance to your money. And then we have index universal life policies. This is the new life insurance policies that I'm teaching people the most about because there's just no awareness for it. And we like it because it's safe. The insurance companies guarantee no losses in this policy due to the market. And also the growth mirrors the index fund, typically the S&P 500 on average, but you also have the Barclays index as well as the US Paysetter and a few other index funds that you can have it attached to grow your money. And typically people don't like it because there's a growth on the profit. There's a cap on the growth. This is a usual case, but there are exceptions, and I just happen to specialize in helping people get set up with those exceptions. So on the right is a visualization of what it looks like. This is the 0 to 9%. Every time the market goes up, you get the gains. Every time the market goes down, you lock in your gains. You don't lose any money. You lock in your gains, so you have a 0% floor. All you have to do, wait for the market to go back up again.
So I think we need to hear that again.
No
Repeat
problem.
that one.
So this is a visualization of a typical indexed account. When the market goes up, let's say the market goes up 5%, you get that 5% growth. The market goes down 10%, you're at zero. You're not losing any money whatsoever. You're locking in your gains. That's why this is a plateau right here. When the market goes up again, let's say the next year, you get the growth. Market drops, you lock it in. This is uninterrupted compound interest. There's not many accounts that can do this. And I know some of you know about whole life. I'll break down some of the differences as well, but whole life isn't like this. Whole life is just flat growth going up because you have the fixed interest rate. Now I'll break down the key differences between those policies in the next slide. So we have whole life. Whole life is the standard permanent life insurance is what most people know. Key benefits, yes, it's permanent. There's fixed cash value, so you're not really at the mercy of any market, really. You're going to get the amount no matter how old you are or what happens to the world. There's is a tax-free vehicle according to tax code 7702. You do have living benefits with this. They're not as enhanced as IULs, but you do have living benefits. And there's fixed payments. You don't need to worry about your payment going up as you get older. A key negative for this, you have fixed growth. You're not maximizing the amount of money that you could be making during your lifetime. Then we have index universal life policies, or IUL as is most commonly known. So the key benefits for this, there's a permanent policy if it's properly structured. The policy can lapse sooner than later. It's an index cash value that's a 0 to 9% I mentioned before. There are exceptions, and I'll show you those exceptions. Then it's also a tax-free vehicle. IULs are based on whole life policies. Whole life came out in the 40s. IULs came out in the 90s. It's just an upgraded version. It's not a whole new thing. It's an upgraded version. There's living benefits included. Not all carriers have this. The carriers that I particularly work with do include that for free. And then you have flexible payments. You have either have flexibility going up or flexibility going down. I'll show that in some of the case studies that I'm going to do as well. And one of the key negatives and why a lot of people do not like this policy and why a lot of people talk bad about it is the cost of insurance increases as you get older. If this is not accounted for and your growth does not keep up with the cost of insurance, the policy will expire. And that's why I inferred earlier, if it's properly structured, it's permanent. So that's index universal life policies. So we have a quote by Warren Buffett, who just so happens to be the 5th wealthiest person in the entire world. I checked this last month, matter of fact. So rule number 1 is to never lose money. This entails principal protection. Rule number 2, never forget rule number 1, because it's going to take you, oftentimes, let's say you lose 50% in your portfolio. It's going to take you twice as long to get that money back. You're going to need 100% gains to get back to where you were. If you have a plateau, 0% floor, you're not going to lose anything. You're not going to have to recover it. You're just going to be getting money. And I don't know about y'all, but that sounds great to me. Jose?
Hey, so let me ask you this. So, because since you and I talked in DC, right? I'm reading a lot about this. Here's kind of the story. Tell me if I got this right. Whichever way you go, in essence, what you're doing with insurance is that you are becoming your own bank, right? And
Right.
so here's the kind of scenario. Say I buy a policy, it's $100,000, death benefit, right? It just means when I die, my family gets $100,000, right? In essence, what I'm doing is I am borrowing against that policy. So say that $100,000 policy, there's a cash value. I'm just for simplicity's sake, it's 50,000, right? So it means I can actually take a loan out of that 100,000 of 50,000. So instead of me going out to a bank or going to a car dealership and getting that nice shiny Beamer or whatever it is for $50,000, and then here, sign for our financing for 3%, whatever, right? Because when I do that, all that money's going out, right? I'm paying the dealer and I'm paying the bank, and I may be paying 50, but I'm actually paying 70, right? When you add everything up, right? I'm just kind of roundabout. The difference that you're talking about, if I do it the way you're saying, is that I'm taking a loan against my death benefit of $50,000. So I'm taking that, paying the dealer right away, and then I'm paying back my policy, AKA family bank.
Yep.
And then the money so I'm getting my own money back. And then say if I do 3%, the 3% I was going to give to the bank, I just assign myself 3%, that interest rate, that goes back into my policy, and that grows over time, and that also compounds.
Yes. Yep.
And you can do that with
100%.
cars, credit cards, investment properties,
Anything.
whatever. Do I have that right?
That's exactly correct. You can use the money for whatever you want. There are 0 restrictions. If you want to take a loan from yourself and give money to a homeless person on the street, you can do that. There's no restrictions to that. And really one of the key benefits of this, you're avoiding the skyrocketed interest rates that it is now. So typically, the standard interest rate on policy loans with insurance companies now is 5%. There's not many places you can get a 5% interest rate. Credit cards, you can get a 0% interest rate for 12 months, 13 months, 18 months. Eventually, they're going to swing you up to 22, 23, 24%. There's no way to avoid that unless you're going to transfer to another card. You're just going to be playing that game. Why not keep it in house and pay that 5%? And in some cases, you can just be paying a half a point. And I'll be showing that there's a way to get a loan like that where you're only paying a half a point every year for the first 10 years. And then after the 10 years, it's a 0% interest loan.
Okay, thank you.
No problem.
Man, this right here sounds like the greatest secret never told.
It's going to get interesting for sure. I'm just on the foundation right now. So
We do have one question I want to get to. So BJ
Okay.
asks, what happens if I die before I repay any loans I take out from my death benefit?
Perfect question. I'm gonna get into that with this case study and break down everything to the T. So we have Alex here. Alex, 32-year-old, full-time fix and flipper. He wants to use infinite banking to pursue the BRRRR strategy, buy, rehab, refinance, repeat, and deploy his money within 2 months. He does not want to pay any more than 10 years into this policy. And he has $100,000 in business savings. So let's break it down. Let me stop sharing real quick. I'm gonna change screens. Cool.
So let me find out you got like 7 screens up.
I have 3. Not too many. All right. So here's a company called National Life Group. National Life Group is one of the go-to insurance companies that we work with. I'm a part of a brokerage called Experior, and we work with about 50 different insurance companies for different reasons, different products. National Life Group has one of the best IULs on the market. IULs is what I suggest people to use the most because you're maximizing your cash value growth to use infinite banking. If you want a conservative approach, go for whole life if you want to. But if you want to maximize the money you're getting in the shortest period of time as possible and protecting against the market, IUL is where you need to be. So this is a max funded policy. Max funded means I lowered the death benefits to the lowest legal amount and maximize the amount of cash growth that you're going to have in this account. And that is because I lowered the cost of insurance that you're paying monthly, annually, semi-annually. So it sustains itself later on into the policy. Now, it's a few things to highlight here. Okay, let me get this going. So the initial face amount is this. It's 1.3 million. Initially, Alex has $1.3 million in coverage that's going to be going to his family, whoever he designates once he passes away. That's the initial face amount. Now, another thing to look at is this lapse year. This is the year in which the policy will expire. For this, it's not applicable because this policy will last for the rest of his life. It will never expire. That's because I max funded the policy. Now, there's no MEC year, meaning there's no year that the IRS is going to choose to tax this policy. So this is a completely tax-free vehicle as long as he stays under one particular threshold. And I'm gonna touch on that. So designated that he's gonna be doing 65,000 annually, but I made it more creative and only had him do this for the first year. Again, he's a fix and flipper. He has a lot of money in savings. We don't advise him to move all his money over into an IUL because you need some money for a rainy day anyway. Now here is the MEC premium. I'm gonna mark this in red. This is the most important number for you. It's for Alex. MEC premium is the amount that you cannot go over. If you go over this, you will be taxed, just like you withdraw from a 401k before you're 59 and a half. You do not want that. So he's doing 65,000 for this. I gave him a little bit of wiggle room going up. So he can, the max that he can put in is $68,106. If he goes over that 1 penny, he's going to be taxed on any withdrawals out of this policy. That's not ideal. Now, he also has flexibility, 65,000, but to keep this policy in place with some type of growth, he can drop all the way down to $11,622. This is one very, very key difference between IUL and whole life. Whole life, you got to pay the fixed payment. You don't have that type of flexibility. Now, break it down a little bit more. Oh yeah, go ahead, Jose.
Hey, want to make sure. So some I just read too. So MEC, right? It's like modified endowment contract.
Yeah.
That's, I think BJ was asking that question because from my understanding, what they did was the government said there were people dumping a ton of money in these policies to avoid taxes. So if you guys know, like Peter Thiel, the good friend of Elon Musk, who created PayPal and some other companies, he dumped a ton of money in 401ks and avoided like hundreds of thousands, not millions of dollars in tax because of what he did, and the government changed the rules. That's the same thing, right? MEC is they limit how much you can put, to it be considered a policy versus an investment. Is that right?
That's correct. Because a lot of millionaires and billionaires when this first came out, they were opening up a policy for like $10,000 a year and dropping in millions, not having to pay taxes for it. So the IRS had to put a hold to that and to avoid some of the money laundering schemes as well. Now, this MEC is adjustable. And for this, it was 65,000. I gave him some wiggle room. So he's not flying close to the sun. That particularly is the case, yes. So modified endowable contract is basically the IRS having a hand into the policy, setting a limit to it. This limit is adjustable, is based on the premium that you're doing as well as the face amount, which is the death benefit. It all depends on your needs. This is a completely 100% customizable vehicle. For this case, I just based it off of Alex's needs. He wants to use this to do a burr. Now, year one, he's 32 years old. Put in $65,000 into this policy. The cumulative value is $61,238. Why did it drop? It dropped because he had to pay the cost of insurance. Cost of insurance is about $4,000. That's the insurance company's profit pretty much for you being able to use this vehicle. I lowered it to the lowest legal amount. Typically, this would be a lot higher. He'd probably be around 50,000 as his accumulated value. But now he has access to more money that he can use for his own infinite banking purposes. Now, surrender value is the amount that he has access to withdraw at any period of time. Now, surrender value is $61,000. He puts in 65,000. He has access to 61,000 that he can withdraw as a tax-free loan from himself 2 weeks after putting that amount in and open up this policy. Let that marinate for you guys a little bit.
Yeah. So there's almost instantaneous.
Almost instantaneous. Now, compare that to 401k, you're tied up for years. Some IRAs, you're tied up for years. You have access to this money a couple weeks after opening up the policy. So he can take out 61,000 and put that as a down payment towards his rental property that he wants to do. He has that availability to do that now. Now, this is the key thing. I didn't even go over infinite banking yet. So this part is infinite banking. The net death benefit is pretty important. That's going to be this face amount right here, plus the cash value that he has in this account. It's increasing as he gets older. So every year as he gets older, the more money he pays into it, the more growth he has is going to be added on to the coverage that he initially bought. So all that money is going to go to whoever he designates once he passes away. Now for living benefit, for the death benefit in year one, $1.3 million, $61,000, because that includes that surrender value. Now, if he takes out let's say he wants to take out 60,000 year one. Excuse my handwriting, I'm using a mouse. 61,000 year one. That money does not come from the surrender value. It comes from the net death benefit. This goes towards what Jose was saying earlier. So essentially, you're using your cash value in this account as collateral. And if you do not pay this money back by the time you pass away, it's going to be way less. So let's say he passes away year two without making his second year in payment. He's going to have $1,301,238. So it's going to be subtracted by the amount that he took out because he has an outstanding loan balance. It's going to come from that net death benefit instead of that surrender value. And what's going to happen is the surrender value is going to keep increasing and increasing and increasing as if he never took the money out. He's using the same dollar twice and having tax-free access to it via the loan. This is the concept known as infinite banking. Yep. Go ahead, Jose.
I think that's a very key point. You guys think about it. And I think this kind of Jean-Louis asked a question, like, is the withdrawal the same as taking a loan? Can it be paid back? The idea is you're borrowing from that net death benefit, right? And essentially you're your own bank, you're borrowing from your own bank, and you do want to pay it back. You want to treat yourself right? That's the idea.
All right.
But that's what you're talking about is you are borrowing for that instead of going to paying for credit cards and cars and other investments that, they make a ton of money off of you, right? I think that the number I saw for every dollar a bank has, they make $9, right? So it's something in that range because they are able to just roll the money over and over. Here, you're taking that money from your net death benefit, and then you're going to pay it back, and it keeps on growing. And they see that larger thing. It's you're even though you take 50,000 out, they think that money's that they see the 50,000 is still there. It's just gonna the idea is you're gonna pay it back. Is that correct? Is that safe assessment?
Yeah, so you don't have to pay it back. Ideally, you should. But worst case scenario, if you don't pay it back, it's going to come out of the money that's going to be going to your family when you pass away.
Yeah.
Now, essentially, this surrender value account is basically a ledger account. This is not the surrender value is going to change, but this accumulated value isn't, because this is really what the interest is accumulating on. It's still not changing as he gets older and older and older. No matter how much money he takes out, that amount never changes because he's taking out a loan against his policy. So that's really the infinite banking concept. Now, a
Yeah.
couple things to also point out to enhance the flexibility perspective. So year 2, I didn't say that he has to put in 65,000 again. He might not have that good of a year doing flips. So give him some flexibility. Now, year 2, we designated he can put in 30,000 instead of 65,000. Year 3, put in the same amount, 30,000. Year 4, put in the same amount, 30,000. Year 5, he doesn't have to pay. And so on for the life of the policy. He only has to pay for 4 years and the policy will last forever.
Yeah. I think that hits Andrew's question. How long do you have to pay it back approximately? Right, you hit that.
Yeah, your whole life. Your whole
The
life.
idea,
There's
if you
no
take the money out,
prepayment
you don't
period.
put it back, you're not able to use it again for something else. That's kind of the
So what will happen if let me erase this. So essentially, if he doesn't pay the money back at all, this column right here will drop because he doesn't have access to take out another 60K. He only has 61 in there to begin with. That's his credit account. So he takes out 60K. The amount that he can take out again is going to be 1,000 for that first year. The next year, he's going to pay another 30K into it right here. So it's going to be 31K plus whatever his growth is that he's going to have access to in this account. And so on. He's going to keep getting growth and growth. Let's say he doesn't take out another loan until, I don't know, year 7 right here. It's going to be the amount that he paid into minus the 60K that he took out and the interest that he has available to take out next. So you're not really taking the money from the insurance company, using the money that you have in the account as collateral. I can't see the chat. There's people
yeah.
asking
I was gonna
questions.
say. So BJ asked, why is Alex only paying for 4 years in this case study?
To give him flexibility. He can pay for more. I have it set up. The minimum amount of time that he has to pay for this policy is 4 years. He wants to pay 10 years, he can. But I gave him this flexibility. And if I made it less, the policy is going to expire. So this is making pretty much just a middle ground. So give it some flexibility. Also giving him enough growth that it will keep covering the cost of insurance for the rest of his life. IUL's cost of insurance increases as you get older. That's one key difference between this and whole life. Whole life is leveled out for the rest of your life. IULs increase. But if you have the growth in your account outperforming the cost of insurance, it's going to sustain itself.
Yeah.
That's a key point for this.
Yeah,
This
so the
one
plan
asks
premium
another question.
is actually planned prior to or on the way in, on the way going in.
Yeah. Yep. So whenever I meet with a client, figure out exactly what they want to do and structure it based on what they want and their goals. You can open up as many IULs as you want. But if you wait 5 years to open that one up, your rates are going to be a little bit different because you're going to be older. You might have some health stuff going on. So if we structure it the best way, primarily up front, you won't have to worry about anything down the road. You don't have to open up another policy. If you want to, you can. But we want to get you set up initially so you don't have to worry about anything, and you actually like your policy.
Yeah. So I'm
So
gonna ask a question here from Andrew, but I mean, the point you just made, it's not like you're gonna have one master policy. You could open up separate policies. Like I was talking to somebody, they have a policy for their kids' college. And what they did was, instead of opening up a 529 plan in whatever state they chose, in their mind are like, you know what, instead of me paying $200 a month to some CSP, right? State of Maryland or whatever it is, I'm going to create a policy that's a college plan, and I'm going to take that $200 and feed it into it. So when it comes time to pay for college, I'm going to take the money out, pay the college, and then pay myself back. So I've never really technically lost that money. I'm putting it back, repaying myself
exactly.
over time, right? Is that the same
Exactly.
idea?
Yep. You could definitely have policies for particular reasons. If you want to have a policy open up, let's say, I don't know, you have a toddler that's 2 years old or something like that. You can have a policy for them, pay for 10 years. I can limit the payment time in most cases. You can pay for 10 years, stop paying when they're 12, and now they have access to that money for the rest of their life.
Yeah.
They go up another policy when they're 18 with your advice to them, and pay for that the rest of their life if they want to, or they can pay for a couple years and it'll last the rest of their life. There's flexibility based
Yeah.
on what you want to do. That's a key benefit for this.
Yeah.
Whatever your goals are, we can adjust it to make it work. But there is it's a take and pull with this, because we have to make sure that this is not going to be a taxable event for you. If it is, that defeats the purpose of you getting IUL. Defeats the purpose of you using infinite banking anyway. You want
Yeah.
to pay no taxes for it realistically. So I think BJ asked a question earlier. There's no tax implications for this if you stay under this MEC premium.
Yeah, because it grows tax free and you're earning interest, because you got to go with a mutual company that pays dividends, right? And you get that money back, right? That's the idea.
So,
When
yeah,
you hit
pretty
when you split.
much. So National Life pays a bonus, an interest bonus after a couple of years, which basically is a dividend for them. Other than that, your money is following the index funds. So either S&P 500 or US Pacesetter. That's where you're getting your growth from. It's not really a dividend of how National Life Group does
Yeah.
itself as a company. It's how that index fund does. And then after
Yeah.
a couple of years, if they know you're reliable, okay, you're actually paying this policy and not missing any payments, they're going to give you that bonus, which is, I guess you could say, a dividend.
Yeah, makes sense. I'm going to ask Jean-Louis a question here. So Jean-Louis says, how does a rising cost of insurance affect the policy later in life when a person gets older or closer to death, right? Is that factor included in the illustration?
Yep. So thoughts payments in year 5. Let's go to when he's 100 years old. I can't even see that. It doesn't even go that far. All right. So let's see. 100 years old right here. 69 years after having the policy. Cost of insurance is non-existent. He has access to $5.8 million tax-free at 100 years old. Probably not gonna use the money at 100. Let's go to 80. 80, 49 years of having a policy. He's access to 1.6 million in here. He stopped paying in year 4. He has access to 1.6 million tax-free. Even if he withdraws all this, he's still gonna have 1.6 million getting the money every year.
Yeah.
The amount
It's
that you're
like that
getting
adage,
interest
right?
on never
Somebody
changes.
says, do you want, do you want $100 today, or a penny today and have it double in 30 days? Which one do you want? You want B, because it's going to be a hell of a lot more money.
Yep. So I'm gonna break it down a little bit more. Oh man. Sorry about this. Make me log out. They're really big on security.
Terrell, you said these are that was a tax-free strategy. Right? So, what type of, I guess, source can you use to actually fund the IULs?
So it has to be a bank account.
Okay.
It has to. Now, whose bank account? Doesn't matter. It just has to
Okay.
be a bank account. There's a couple different ways you can fund it. So it could be your own personal bank account, or your business can fund it for you and pay you a bonus. It'd be a tax deductible for your company. It's called executive bonus. So there's a lot of different ways to leverage this. If you guys want to talk about executive bonus in more detail, we can hop on another call later. But I'm not gonna get too in depth with it. That is an avenue that you can pursue, though. It just has to be a bank account. All right, so
You
let's look
can't
at
say like
this.
a retirement plan, roll it over into this and start.
Yeah, you can't do that too. Um, you can't roll over. Let's say you have a 401k, you cannot roll over a 401k directly into an IUL. They're just not the same tier of product. But what you could do is roll that over into an annuity, a fixed index annuity, and you can get the IUL through your annuity.
Gotcha.
So you're working around it a bit, and you're using your 401k to fund it. So that's one avenue that you can pursue. I'm gonna touch on the policy charges a little bit, so you guys can really see what the cost of insurance is. All right. So I know this looks like a lot, but bear with me. I'm gonna break it down. Just follow the highlights. Okay. So year one, Alex puts in $65,000. Ignore these for now. This core thing I want you to look at is this amount. This is the sum of all the charges over here. So ignore the X. Just focus on the highlights. So he puts in 65,000 that first year. His policy charge, the cost of insurance, is $7,559. Now, the interest that he gets on that account is a little less than $3,800. This is considering it's 6.5% for the rest of his life, which is not going to be. This is a no cap policy. So he follows the US pay setter, which has outperformed the SP 500 traditionally. The last 20 years, the average has been 15%. This is showing 6%. So the number is going to be a lot higher. So first year, he has $7,559 as the cost of insurance for this policy. His growth in the account gets him $3,797. So he's paying for that first year out of money he put into the policy, pretty much. Second year, policy charge is $5,661. Total credit with this interest, $5,609. Third year, policy charge, cost of insurance is $5,837. His interest, $7,526. On the third year of his policy is self-sustaining and paying for itself. He's not paying anymore after the fourth year. So let's look at when he's 40 years old right here. Policy charge, $4,700. Growth in the account, $12,435. Night and day. He stopped paying at that point 5 years ago. Cost of insurance is irrelevant because his growth is outpacing the cost of insurance because I lowered it. This is a key benefit of a max funded policy. I'm gonna break down another case study. You can see a little bit more specific. But essentially this is the policy charges. And if I scroll down, let's look at a year when he's 90 years old. Cost of insurance typically is super high by then because he's older. 90 years old. $16,336 is the policy charge, the cost of insurance for that 1 year. His interest in that year, $197,000. This is why the policy is not expire. This is why it lasts his entire life. Do we have some questions in the chat?
Yeah, so I got two coming. I think one thing, tell me if I'm right here, and the stuff I'm reading. I think one thing, the concept is kind of mind blowing, but here's a question for you all. I don't have to answer it in the thing, but what do you think, or who do you think is the biggest investor of life insurance? Right? Maybe a related question is, what do you all think banks invest the most in? Car loans, mortgages, whatever, or is it life insurance policies? It's life insurance, right? I think it's called BOLI, right? Bank owned life insurance.
Exactly.
Banks,
It's a tier one asset
Yeah.
class for banks.
So banks are the number one investor holders of life insurance policies. Think about that, right? It's not your car loan, it's not your mortgage, it's not your CD, it's not your college savings plan, it's any other financial instrument. They're the number one holders of life insurance policies. Think about that, right? We don't have access to that BOLI thing. That's what you're talking about is. So think about that, guys. They own life insurance policies. That's how they're really exponentially making their money. Then you start thinking a little like that's how you start thinking differently here, right?
Essentially, this is an asset. You're creating your own
Yeah.
asset based on your own life and the money you're putting in.
So let me ask one of BJ's questions. Can you help me understand the relationship between how many years he pays the plan premium and the target premium? You kind of hit that, but maybe kind of explain that again.
How many years?
Yeah, can you help me
Plan
understand the
premium.
relationship between how many years he pays the plan premium and the target premium?
Okay. So the amount of years he pays does not affect the target premium at all.
So where does that target premium come from then? I'm not sure where that number comes from.
Yep, that's relative to his face amount, which is here, and his initial amount that he does. So the duration of him paying doesn't affect the target premium at all. It's based on the initial numbers. Does that make sense, BJ?
Okay, yeah, I think I got it. Thanks.
No problem. And Jose, you said it was another question.
Yeah, Andrew asked, just lost it here a second ago. I also saw something about getting credit lines like 150,000, for example, and put it into an IUL to have that money to put into, say, an investment like a multifamily unit, the cash flow and pay it back. What are your thoughts there? How can you, does that work?
Sounds great to me. I don't see why not. I mean, as long as you take that line of credit money and have it in a bank account, you fund the policy, go for it.
Yeah.
And if you're healthy enough to get it, because at the end of the day, this is life insurance. If you're uninsurable, you probably won't be able to get this, but you can be the owner of the policy and have someone else be insured. So if you're married, you can be the owner of the policy, use it for your own investment purposes, and your wife can be the one that gets the health check.
Yep.
All right.
Yeah, I think Andrew, there's a video I saw, I'll try to look for it. But basically the guy was talking about the exact same thing, like you're using your IUL or your insurance policy to buy an asset. So along with the asset appreciating, right, over time, because you bought the money or bought that asset with the IUL or the policy, your policy is also increasing. So you're double dipping, right? Your asset is increasing and the value of your policy is increasing. So you're winning in two ways. Now, sounds to me, but you got to make sure you work with professionals, someone like Terrell, and get your accountant also. The Thomas family do very well on properly setting up their business. They can talk about this all day long, but you got to make sure everything is properly set up. But if you set it up properly, I mean, that's why some of the wealthiest people have the proper people on their team to properly set this up. to follow the rules, but you follow the rules and you're also exponentially making money.
Now, the biggest thing that I think you guys need to know is that I don't recommend you work for, I don't recommend you work with someone that works for an insurance company. And the reason being, they can only sell their products. So you're basically short because they can't recommend you the best product on the market or what really works for you. They only recommend what they have. Like Aflac can only sell Aflac. They're not going to recommend a competitor. It's not in their best interest to do so. Now, let me create this other policy for you guys. I'll be moving on to the next case study. Any other questions in the meantime?
Let me double check. I know I missed one from Jean-Louis. Is there any guarantee that performance will outgrow the increasing cost of insurance?
Is there any guarantee that it won't?
Yeah, is there any guarantee that performance will outgrow the increasing cost of insurance?
Not necessarily, because can't guarantee what the market does. That's the key thing with this, is based on what the market does. Now you have a
Okay.
0% floor, but they can't guarantee any growth on the policy realistically. National Life Group can't. Now there's other companies like F&G. F&G can have a guarantee of, I think, like 2% or something like that. Have to check with their product guys who work with like 50 different carriers. But with them, you have the guaranteed growth in your money. Now, let me show this.
Yeah.
All right, so I'm move on to the next case study, and then be pretty much done. So this is the thing that sucks about having multiple screens, Lawrence. So let's look at Colin. Colin's 46 years old, full-time W-2 employee. He wants to get into real estate, doesn't have the time, and just lost money in his 401k. But he's currently contributing $1,000 a month into his 401k. So he doesn't want to lose any more money. He just lost money. There's no penalty for stopping the funding, stop contributing to your 401k. Typically, definitely check on that. There's different companies for 401ks, but typically it's not any penalty for that besides you not getting the match anymore. Match isn't all that great in the first place, but if you can be having an account where you're not losing any more money and still getting the same gains of the 401k, why wouldn't you want to do that? All right, so with him, let's get that set up. And this is where I'm going to be showing the differences between target premium and max funded policies. On the previous one with Alex, I did what's called a balance sheet rider. That's typically for people that have a larger lump sum of money. So he had access to 91% of his money in the first year. That's not normally the case, but since he put in a large lump sum, we can set that up for him. So for Colin, he does not have a balance sheet rider. This is a max funded policy, just like the one I showed you. Some of the differences are here as well. So policy does not lapse, does not expire. There is no year where this policy becomes taxable. He's doing $1,000 a month, basically replacing his contributions he's already doing in 401k. Not coming out of pocket for any additional money. Now for this, he has a MEC premium of $12,000. So for this, I didn't give him any flexibility. I definitely can, but for this, I just did 12,000 because he says he's going to be doing 12,000 a month. If he goes over this one penny, he's going to get taxed. So I can definitely give him some flexibility. Now, target premium is what BJ mentioned earlier. For this, you drop down to $3,000 annually. So he's doing monthly payments. So what does that equal? 3,000. I'm around it up. 3074 divided by 12. He can drop down to $256 a month and still keep some growth in this account compared to a $1,000 a month payment. That's the flexibility he has. With this one, he doesn't have any flexibility going up. That's not what he wanted. You can always add that again. It's a very flexible policy. His initial face amount, the amount that's going towards his family, if he passes away the next day after funding the policy, is going to be $171,000. Let's jump into the numbers. So age 60, age 46, first year of the policy, he's putting $12,000 a year, $1,000 a month. That's the plan premium. The accumulated value is going to be the amount that he put in minus the cost of insurance. In this case, the cost of insurance is $12,000 subtracted by $10,529. His cost of insurance is $1,471 for the year. This is very big, so let's put this in. So 1471 is his cost of insurance for the year. Again, he's doing monthly payments, so it's important to know what it is monthly. I'm gonna divide that number by 12. So $123 a month is going towards the cost of insurance, which is the insurance company's profit, which means the difference between, let's see, 1,000 a month and that 123 is going towards his account for infinite banking. So $877 a month is what he's going to get in his account. That's going towards the accumulation value, which is right here. Now, year one, his amount that he's getting credited on in terms of interest is $10,529. He has access to take a loan out for $6,659. Again, let's say he wants to take out $5,000 that first year. I'm gonna take out $5,000 first year. This amount does not come from this. It comes from this. So if he passes away year two without making the second year's payments, is going to be the 181 minus $5,000. Now, the accumulated value is still going to be getting interest credit to it. Even if he takes out that money, year 10 is going to be him being 55. He's going to have interest getting credit on $72,901. Even if he took out that $5,000 loan and didn't pay it back. So this is what it looks like from a max funded perspective for IUL. I'm gonna take questions right here before I jump into what it looks like target premium, which is what most people talk about IUL as.
Yeah. Yeah, I think you kind of hit one. One was how long do you have to wait to pull the cash value, right? You kind of hit that already, right? Or did you want to say anything?
Yeah. Yeah. As long as the amount of money here in this surrender value, you can take out money.
Yeah. Yeah.
Typically after 2 weeks. It depends on how much is accumulated in there. He's doing monthly payments, not annual payments.
Yeah.
So he probably has to wait a couple months to get the amount that he wants to take out, but he can take out money that first year.
Yep. Jean-Louis said, hey, I think you hit it, man. I just dug a bit and it looks like there's a book called Becoming Your Own Banker by a guy named Nelson Nash.
Yes.
That's the godfather. That's the guy who created all this. Am I correct? Or IBC?
Yeah, that's absolutely correct. And one thing I would tell you, there's maybe one book at all on using infinite banking with index universal life policies. All the books pretty much on whole life, all the books on infinite banking are based on whole life. It's outdated. I just showed you the power of index universal life policies with the growth. And this is a max funded policy. So what they're saying about the policy not going to last, we're seeing the contrary right here.
Yeah.
So Nelson Nash's book is great, but talks about whole life primarily. Again, it's good, but you're not maximizing your opportunity. You're not leveraging your money to the fullest. Is there another question?
I'm going through. where can I sign this up with you to get myself, my wife, my child, my neighbor, my barista at Starbucks? Is that what you're asking, DJ? Is that right?
Name drop, number drop. Put your
Yeah,
contact
listen,
info in
I'm
the
gonna show my
chat.
QR code at the end of the slide.
Yeah.
And I'll drop my information in the chat as well for you guys. Was that the last question for now?
I think so, yep. Because
Okay.
Andrew asked the last one about how long to wait for a cash value. So yep, go ahead.
So now I'm gonna show you guys what it looks like, really what IULs look like that people hate so much. Why Dave Ramsey hates IULs, why Nelson Nash doesn't talk about IULs and recommend them. Even the guy that Pace brought on doesn't recommend IULs. There's a particular reason why. It's completely warranted. If the insurance agent is not educated enough to do max funded policies, then they're screwing up the client. So I'm going to change one thing. One button is what I'm going to change. All I'm going to do, click based on target premium. I'm going to go back. Now, what key differences do you guys see right away?
Well, there's a lapse year for one.
Yep.
Yeah, Tony says surrender value. Yeah. Looks like a whole life policy.
Exactly. So really, there's 4 key things to look at. I'm gonna point them out. First thing, why does he have so much death benefit? He's using this for infinite banking. He doesn't need that much coverage. This is not for just a life insurance policy. Now we always suggest that the individual gets a term policy as well as an IUL. The max funded IUL, and then you get a term policy. You can always convert the term policy to a permanent IUL down the road, depending on what the carrier is. So that's making sure you have enough coverage. I don't recommend using your IUL for primarily coverage purposes, unless you just don't want a term. So there's different flexibilities for it. But for this case, he doesn't need that much coverage. He doesn't have access to any of that money while he's alive, unless something happens to him, he gets sick, or car accident, COVID-19, whatever the case may be, he get access to that money. But right now he's perfectly healthy. He can't touch that money. So what's the use for it? Now, the lapse year, as BJ pointed out, the policy expires in 24 years. I'll go down and show how the numbers change towards that point. That's not good for him. He's going to lose all the money in his policy. Let's say he never takes out a loan, ever. 24 years down the road, he loses all the money he's had into the policy and his coverage. Not good for him. Now, third thing, sorry. The target premium. He's already doing $12,000 a month. He has no flexibility whatsoever going down. He can't even do $999 a month. He has to do basically $1,000 a month for the rest of his life, well, for the next 24 years, to keep the policy in place with some growth. Not good for him. And then last thing, surrender value 0. He has access to withdraw as a loan, $0 his first year. This is the huge negative of a target premium policy. And the cost of insurance is so high. And that's why this policy lapses, BJ. And let's do some quick numbers, just like I did for the other one. Cost of insurance for the first year is $12,000, which is what he's paying annually, minus the accumulated value, $7,917. His cost of insurance is $4,083 for that first year. It's a huge jump from before. And let's look at monthly payments again. Monthly payments, divide that number by 12. So $340 a month is going towards the insurance company as profit. And that is why this amount is really big. So they're working hand in hand. Cost of insurance is covering that large death benefit. So he's going to be having, instead of $800 something going towards his cost of insurance, he's going to be having $660 a month going towards his cash value growth. Significantly less. And that makes a big difference. So let's say second year he put in $24,000 into his policy. He has access to withdraw less than $2,000. This is 2 years of having this policy in place. A lot of whole life policies look like this. There are variations to it. I had a whole life before. I was paying $250 a month into it for 2 years. The second year, I wanted to take all my money out that I possibly could. They told me I could only take out $300. I'm like, what? So it's out there like that. And this is what target premium policies look like. When people primarily mention IULs, this is what they're talking about. This type of policy, target premium policies. They're not talking about max funded policies. A lot of agents don't know how to do that properly. So these are the key differences, and it could be altered. This lapse year can be increased if he made payments every year, but this also means he can't only pay for 5 years. He doesn't have as much flexibility. Now let's go down. Policy expires when he's 69 years old. 0, 0, 0, 0. Loses all the money, all the value of this account when it lapses. That's a big negative with target premium policies. And this is why you want the policy counteracting the cost of insurance. But that's not doing that. Cost of insurance is eating up this policy. He's a bit older. He's not super young. So it's not ideal for him. Questions? I know it's on.
This just seems
I
like
don't
a
think
lot of
in
wasted
here.
time right there. Sorry.
Go ahead,
It's just-
Lawrence.
My mind is blown. It's like looking at this is like that's a big waste of time. Like you put all this time, this money, and this effort into this policy, and then all of a sudden it's just gone out of nowhere.
Yeah,
Yeah.
yeah. And I think this kind of relates to BJ's question. So my wife and I have term. I think a lot of us are told buy term, invest the difference, right? That's kind of like the phrase people have used. Basically, what you're saying here is because when you do term, after 10 years, it's done, right? You can increase, but as you get older, you can do like annual, you can add 1 year increments, but the cost goes up more because, actuarial tables, like insurance people are smart. They base
Yeah.
everything on
It's life
knowing when people are
insurance.
going to die, right? And pay people off, right? But that's the difference.
It's life insurance. I'm gonna give you a bit of insurance education. Term policies through your jobs are trash. They don't have living benefits typically. Living benefits is if you get an accident, you break your leg, you get a heart attack, COVID again. They don't cover that. And typically it's it's a multiple of your income. When you leave that job, it either severely diminishes or is gone.
Yeah.
You want to get a term policy that is individual to you, that has living benefit coverage, and typically has the ability to be converted into a permanent policy. Again, if you're working with an insurance agent that only works for an insurance company, they can only recommend their products. Aflac, for example, only recommend their term policies. I don't even know if they have one, but if they do, that's it. So you want to work with a brokerage that can give you options, show you different ones. You tell them what you want, they should be able to suggest certain things that make sense. Not just be like, okay, here, this is what you wanted. No, because sometimes you don't really know what you need, considering you're not an insurance agent. So you want to work with somebody that's knowledgeable as well to make sure you're set up correctly. But yeah, this is a target premium policy. This is what's most commonly referred to when people mention IULs and tell you not to do IUL. I guarantee you, if somebody says don't do IUL and you ask them, is it based on target premium? They're not going to answer you. They don't want to acknowledge it.
Where's the PUA? Like what's a paid up additional?
There are no paid up additions with Next Universal Life policies. That's a whole life thing.
That's a whole life thing. Okay.
Yeah, this is a whole life thing. 'Cause, I mean, for this, I have it set up. He would pay in full in 5 years. This is a target premium policy. So look, let me change it back. So I'm gonna just click this button. As simple as that. So now it doesn't lapse. Death benefit is much lower. He has flexibility. He has access to over half of his money in the first year that he put into it. And the policy is sustainable with him only paying 5 years. Like, this is something similar to the paid up editions, Jose. But I know with whole life you have to pay for the living benefits typically. This is already included. You go to the riders right here. You have terminal illness rider, chronic illness rider, critical illness rider, critical injury rider, and Alzheimer's. And the same thing goes for all the term policies that I recommend. So all your coverage has living benefits and you have access to a percentage of the death benefit at any given time. All you have to do is file a claim, call the insurance company, or talk to me, or whatever the case may be. So this is what target premium policies look like versus max funded policies, not overfunded, max funded policies. Overfund is a little bit sketchy. If you overfund, that typically means that you're going above this MEC premium, which means you're going to be taxed. You want to max fund it. If you want some flexibility where you want to be able to put in, let's say you have a policy like this. Let's say Colin has this policy of $1,000, but he wants the flexibility to put in another $750 if he needs to. That's not really going to be too much of a max funded policy. It's going to be a little bit of a blend between max funded and target premium, but it's not going to be on the extreme of a regular target premium policy. It's still going to be more towards the max funded. There's different ways of going about it, and I'm helping some clients out now with a couple blends where it's not purely max funded and it's definitely not target premium because they want to use it for infinite banking. If you want to use a policy for infinite banking, it needs to be more towards max funded, if not purely max funded. Any questions right now?
Yeah, so Andrew asked, how long does National Life take to pay out a claim?
Not too long. I think it's within a month. Within a month, you can't file a claim, I believe, up until a certain duration of time. I had to check with National Life Group specifically, but all the carriers have their different timelines because they all have different products, different product versions. But typically within a month. All right, is that the last question?
Yep.
Cool. Let me go back to the slides. We're almost done, guys. No, I dropped a lot of information.
Yeah, I think my head is like boom, 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 boom. Because even though I've seen this before, like I still pick up gems every time.
I'm glad, man. All right, so this is a couple uses that you can use infinite banking for in terms of real estate investing. So Gator lending, you set up a policy, lend EMD out, and not have to worry about it being lost because it's just going to come out of your death benefit. So that's one benefit. Private money lending, you be a private money lender, you can lend for the down payments or complete purchase of the property. Self-fund rehab for creative deals. Most of us know you can't get a hard money loan for creative financing. So this is one alternative to getting a private money lender. You can be your own lender and do this instead of you getting a credit card or a line of credit. Same thing goes for a down payment for a flip. You can self-fund that. You can self-fund a down payment for a rental, and you can furnish a short-term rental or a midterm rental. Typically, when people need to furnish that, they're either coming out of pocket or they're taking money off a credit card. And it's kind of tough sometimes to figure out the payback schedule for a private money lender, especially if you're doing arbitrage. This is an alternative to that. If you do infinite banking, you don't need to worry about any of that. All right. And this is a quote I want to leave you guys with for that. Robert Kiyosaki, author of Rich Dad, Poor Dad, he once said, it's not how much money you make, but how much money you keep, how hard it works for you, and how many generations you keep it for. This is very important. The Rockefellers are already using this for generational wealth. Why not tap in and start using it yourself for generational wealth and asset protection? If you have I'm gonna give you a setup right now. You have a life insurance policy, you'll see your IUL, max funded IUL. The beneficiary is going to be a trust. The trust designates where the money goes. The trust will end up being your family bank once you pass away because that lump sum, the death benefit, is going towards your trust. You set up the trust the right way, it's untouchable with lawsuits. That's just money for your own family forever. You can set up the trust to take out life insurance policies for newborns on your legacy. Once they pass away, it's going to be passing back to the trust. That's what the Rockefellers do. They have life insurance policies going towards a trust. The trust of their family bank. They have managers for it. That's why they're untouchable in terms of money. And a couple action steps for you. So considering what I went over today, I want you to request a copy of your policy from your existing agent if you have a life insurance policy that's really, even if you have a term policy, you want to look over it and see if it's really aligned to what you want. And then I want you to check the growth in your retirement accounts. If you have a 401k, self-directed IRA, Roth IRA, or a traditional IRA, whatever the case may be, TSP, check on that to check the growth. If the growth is not where you want, we can have a conversation about you adding insurance to that money so you never lose any more. And then I want you to think ahead to the future. Think about wealth generation, wealth protection, asset protection. And think about your kids and your kids' kids. If you get a life insurance policy, I'm not going to say today because I'm not here to sell anyone, just giving information. If you get a life insurance policy this year sometime or whatever the case may be, that lump sum, once you pass away, is going to be going towards whoever you designate. That's going to enhance their lifestyle. If you educate them to do the same, you're just going to be setting up your family for generations to come, starting with you. And I'm offering a free policy review for anyone that's interested in that, whether it be the term policy, whole life, or if you have existing IUL, to show you what it looks like from the insurance agent's perspective, if it matches up with what you want, because I'm going to be asking you questions, and what we can do about it if it's not what you want. And then here's my contact information. You can scan the QR code, just hover over with your camera, and you'll see my blink. And I cannot send a blink right now. Let's see. Let me put my phone number in the chat.
While people are scanning, I think, hey, Barry, good seeing you again. Last time I saw you was in Frederick. So I think you kind of hit his question, said, he has an IUL already. Can you please go over that last slide again? I want to know how I can utilize my funds for REI, right?
Sure.
And
Yeah,
before you do that, I want to pause the recording or stop the recording. I think we got everything we need because I feel like this is gonna go. It's gonna take a leg on it. So I'm gonna stop the recording here. Terrell, thank you. Again, this is DMV REI Exchange. We're gonna sign off and we're gonna continue post recording.